Somebody checked their credit score today, and it dropped 40 points overnight. They didn't miss a payment. They didn't max out a card. They didn't do anything wrong. They just checked something. Or someone else checked it for them. And by the end of this video, you'll know exactly which one is silently wrecking your score right now and which one is completely harmless. Let's call her Sarah. Sarah was 26, good job, decent savings. She thought her credit was in great shape. She applied for a car loan. Then, 2 weeks later, a credit card. Then a phone plan upgrade. 3 quick checks, that's what the salesman called them, just routine. She walked out of the dealership feeling confident. Then her score dropped. Hard, she didn't understand why, until she learned the truth about something most people never think twice about. Inquiries, and not all inquiries, are created equal. Here's the thing nobody explains clearly. Every time your credit gets checked, it falls into one of 2 categories. One is basically invisible. It does nothing to your score. Lenders don't even see it. The other leaves a mark, a real one, visible to every bank, every lender, every company deciding whether to trust you with money. These are called soft inquiries and hard inquiries. And confusing the two is exactly what cost Sarah those 40 points. So let's break them apart, starting with the one that's actually your friend. A soft inquiry happens when your credit is checked, but no lender is deciding whether to approve a new loan. Think about it like someone glancing at your resume out of curiosity, not actually deciding whether to hire you. You check your own credit score on an app, that's a soft inquiry. A credit card company checks your file to send you a pre-approved offer in the mail, soft inquiry. An employer runs a background check before hiring you, soft inquiry. None of these touch your score, not even a little. You could check your own credit 100 times a day and your score wouldn't move an inch. Sounds safe, right? But here's where it gets dangerous, because one small mistake turns a soft inquiry into something much worse. A hard inquiry happens when you apply for actual credit and a lender pulls your file to decide if they'll approve you. Car loans, credit cards, mortgages, personal loans, every single one of these can trigger a hard inquiry. And unlike its harmless cousin, a hard inquiry does lower your score. Usually just a few points, 5, maybe 10. But here's what Sarah didn't know, what almost nobody knows until it's too late. It's not one hard inquiry that destroys your score, it's what happens when they stack up. Sarah didn't apply for 1 loan that day, she applied for 3, a car loan, a credit card, a phone plan. 3 hard inquiries, all in the same week. To a lender looking at her file. That doesn't look like someone being responsible. It looks like someone desperate for money, someone applying everywhere, hoping something gets approved. Even if Sarah never missed a single payment in her life, that pattern alone made her look risky. And risky people get denied, or worse, approved at a much higher interest rate. This is the part almost nobody tells you. It's not the inquiry itself that's dangerous, it's the story your inquiries tell about you. But here's where it gets interesting, because there's a loophole, a real one, built into the system. If you're shopping for a car loan or a mortgage and you apply to multiple lenders within a short window, usually 14 to 45 days depending on the scoring model, credit bureaus treat all of those hard inquiries as just one. Because they know you're not being reckless, you're comparing rates, being smart. So Sarah's mistake wasn't applying for a car loan. Her mistake was mixing a car loan, a credit card, and a phone plan. 3 completely different types of credit, all in the same week. That combination is what triggered the drop. If she'd spaced them out or grouped similar applications together, none of this would have happened. But there's one more twist, one most people never see coming. A hard inquiry doesn't just disappear the next day, it sits on your credit report for 2 years. But here's the part that surprises people. It only actually affects your score for about the first 12 months. After that, it's still visible, but it stops hurting you. So if Sarah waits a year, her score recovers from those 3 inquiries almost completely, even if she does nothing else. Patience alone heals most of the damage. But there's still one dangerous myth left to bust, one that's probably been in your head this whole time. Most people think checking their own credit score hurts them. That's why so many people avoid looking at their credit report altogether, scared that just glancing at it will drag their score down. That fear is completely wrong. Checking your own score is a soft inquiry always, every time. You could check it every single morning with your coffee and it would never cost you a single point. In fact, avoiding your credit report is far more dangerous than checking it, because errors, fraud, and mistakes hide in the dark, and the only way to catch them is to look. So now you know the difference. But knowing isn't enough. Here's exactly what to do with this information. After learning all this, Sarah changed her approach completely. Before applying for anything, she asked herself one question: is this a soft check or a hard one? When she needed to compare loan offers, she did all her research within the same short window, so the multiple hard inquiries counted as one. She stopped applying for random store credit cards just to get a discount at checkout. And she checked her own score regularly, because now she knew it was completely free, completely safe. 6 months later, her score wasn't just recovered. It was higher than before she ever walked into that dealership. Because she wasn't avoiding credit anymore, she was using it with actual control. So remember this, because it's simpler than it sounds. Soft inquiries, checking your own score, pre-approval offers, background checks, completely harmless, check as often as you want. Hard inquiries, actual loan and credit applications, these matter. Space them out, group similar ones together, and give them time to heal. One glance doesn't break your credit, but a pattern of desperate applications, that's what lenders notice. That's what actually hurts you. If this just changed the way you think about your credit score, you need to see the next video, because there's one credit mistake that's even more common than this one, and it's costing people thousands of dollars without them ever knowing. Hit subscribe, tap that next video, and take control of your credit, starting right now.